Last week, Japanese market cracked 11%, the US markets cracked 3%, and the USD declined 5% against the Japanese yen. These crazy moves could have a cascading effect across the global markets. At the epicenter of these moves are the interest rates in the US and Japan and the associated carry trade. Hello everyone, I am Vineet Rajani and welcome to Zerodha Varsity Videos. And in this video, I will explain to you what a carry trade is and why the world markets are cracking. Let's begin with the basics. Imagine I'm your friend and I lend money to you at 1% interest rate. You can borrow this money from me and invest it in a safe government-backed security, let's say a T-bill, which will give you, let's say, 5%. Upon maturity, you get this money back with 5% interest rate. You pay the money back to me with 1% interest. You pocketed a neat 4% profit. This is what we call a carry trade. Carry trades can be done across currencies as well. Over the last year, many currency traders have been borrowing the Japanese yen at near 0% interest rate and investing them in US bonds at about 5-6% interest. Now, isn't that a 5% clean profit? Not really if you look at the risks. Economic winds could change overnight. Government policies or stability could change overnight. Speculations on economic prospects could cause currency fluctuations, thereby increasing mark-to-market losses. What if interest rates reversed? What if exchange rates reversed? That could lead to carry trade losses. See, different countries have different interest rates. It's the job of their central banks to see the economic conditions, set the interest rates, and monitor them closely. We have seen how the RBI in India and the Fed in the US had been increasing interest rates last year to control the post-COVID inflation. Japan has kept its interest rates at near 0% since 2007, primarily to give a boost to its rather stagnant economy. Now, this is where things get interesting. As long as the interest rates between two countries differ, there is scope for carry trade. Mind you, your carry trade has to be profitable after accounting for transaction costs, currency translation costs, taxes, and even currency fluctuations. The large spread between the borrowing costs in yen and the yield potential of US bonds is what was accommodating these costs and still leave profits for the trader. But this spread started shrinking last week and the risk is becoming intense. There were a couple of reasons for that. The markets were expecting that on the 31st of July, number one, Bank of Japan would increase interest rates, and number two, US Fed would cut interest rates. Now, both these actions would shrink the spread between the yen and dollar, thereby hinting at smaller or no profits. Just the expectations of these actions had led to the Japanese yen appreciating 7% against the USD through July. Now, what actually happened on the 31st of July? The Bank of Japan hiked interest rates to 0.25%, their first hike since 2007. The US did not cut interest rates, but the market is assigning 100% possibility of a rate cut in September. The yen has appreciated 5% since that news. This is after the 7% increase in July. As a trader, you're better off if the borrowed currency depreciates and the invested currency appreciates. This is what had been helping currency traders make profits on the yen-dollar carry trades. But the opportunity to make profits seems to be shrinking with the narrowing of the spread. Do you think a carry trade between the rupee and the dollar could be profitable in the current scenario? Tell us in the comments below. Till then, happy learning and happy investing.